Mortgage rates, the market, the tariff. Everything that's happening in Halifax real estate today. So Michelle, how are you?
I'm great. How are you?
Good. The last time we were together was a podcast.
It was.
That was last year,
It was last year.
Yeah. Well, it was time because so much has happened in the mortgage industry. And I think the biggest thing that could have ever happened to us was it November, December with a 30-year amortization?
It came into effect December.
That was phenomenal. Tell me how your brokers or, what are they seeing?
Well, first of all, it's a change that we've been lobbying for many years, as you know, in the industry. It's relatively new. We're 6 weeks in, 7 weeks in. But what we're seeing is that it is giving first-time home buyers the opportunity to jump into the market.
Yep.
In terms of, what does it do from a payment perspective in terms of increasing disposable income, you're looking at about $200.
That's a big difference, though.
It's a big difference. And so, for a $450,000 purchase, it can make a dramatic difference in terms of qualifying and or the mortgage payment. And $200, just $200 net dollars, it goes a long way.
I agree with you. I had an agent here earlier, and he said his thing was, how busy the market's going to be based on the number of, pre-qualifies that a mortgage rep is doing. So what would you say your reps are doing? Are they doing a lot of getting people ready?
Yes, they are. And, at our firm, our mortgage brokers, we pre-qualify our clients.
Yep.
And I think that's a big distinction from a pre-approval versus a pre-qualification.
Oh, absolutely.
You'd agree?
Yeah. Oh, yeah. It's so funny. I didn't know what a mortgage broker was till I moved to Nova Scotia. But I believe a mortgage broker is the only way to go.
Absolutely.
Just shopping around things. So we just had a Bank of Canada rate, change. Where do you see us heading into 2025 with the Bank of Canada?
Well, all things being, it's difficult to say given the current political and economic climate with the threat of tariffs. Luckily, we've, escaped those for now.
Yep.
But notwithstanding that, the existential threat, I believe that we will see prime continuing to drop over the next year. How many times that will happen, I'm not sure. But when we look at the stats, and I wrote down a couple, because what's interesting is the last time that we were together, we were looking at the end of 2024, well, actually the summer of 2023, prime was 7.2.
Wow,
so it has dropped,
that.
Right? Remember that?
Yep.
And so it's dropped over 200 basis points. And so we're sitting at prime at a level of 5.20%. The next meeting is in March. And I believe that'll be another quarter point. And so where we end up by the end of this year.
What makes you say that, another quarter point?
I think, inflation is low. Inflation is relatively low. We need to increase consumer spending and confidence. And look, if something happens south of the border, and let's say it drives us into a recession, interest rates are going to go down. So, and I don't believe that's going to happen, but I do believe that the cost of borrowing will continue to decrease. Now, what's really important to understand is that the prime lending rate and fixed term mortgage rates, they're not tied closely together.
No, they're not.
No. But having said that, we're seeing downward pressure on fixed term mortgage rates. And overall, it's a great news story compared to where we were a year ago.
So what are your brokers telling their buyers now? Because if I was giving advice, I'm don't lock yourself into a fixed term mortgage. Is that something that, or people want to take that risk here in Nova Scotia?
Well, you just mentioned the word risk, and that's precisely what it is. So, in speaking to our borrowers, your buyers, we take a look at their overall profile. What is their risk profile? Are they prepared to essentially take some losses or gains over the next little while with a variable rate mortgage?
Yep.
Today we're looking at a discount off of prime, which is about 0.65, 0.7 off of prime. And that actually can change. And so when I say that, today at 5.2, let's call it 0.65% off of prime lending rate, you're looking at a effective rate of 4.55.
Which is incredible.
Which is an incredible rate.
Yep.
And if they continue to drop, let's call it another 0.75 of a percentage point by the end of the year. We're now in the threes, mid threes for a 5-year term.
Yep.
Having said that, we can also look at a 5-year fix as low as 4.29% today. So it really depends on the borrower's risk tolerance. Are they willing to ride the market, if you will, with respect to the prime lending rate?
Yep.
And again, I always say, as you know, it's something I always say, that money markets are like people, they're emotional. Anything can set them off. And from a geopolitical standpoint, anything can trigger interest rates in money markets. So again, it goes back to the borrower. Are they satisfied with a rate of 4.29 today? And
But
they
if I
can fix
take-
their payments.
But if I took a variable, I can switch over to
You can.
easily at any point in time.
That's a great point. So yes, you can ride the market, and then let's say a year into the variable rate, prime has dropped. Let's say it's gone down to 4.4. And let's say we're looking at a 3.8 term or 3.75 for the remaining term of that variable mortgage term. You can convert as a client depending on your financial institution. Mm-hmm. That's why it's very important to work with a broker. But you can convert that variable rate mortgage into a fixed rate term, provided that the term remaining is equal or greater to.
So I have another question. So we had, the changes
Yes.
to the 30-year amortization. And then there was also a change to the $1 million market.
Yes.
And what was that again?
Well, this is really exciting.
Because I want to show you the numbers of what happened.
Oh, I'd love to see it. So essentially for default mortgage insurance, that's individuals who are purchasing a home with less than 20% down. The cap was at $999,000.
Yep.
That cap is increased to $1.5 million. So now, having said that, it's not 5% as a minimum down payment on 1.5. It'll be 5% in the first $550,
Yep.
and then 10% of the additional amount. But what that says to us is that we're finally being able to help our borrowers who are purchasing homes over that mark.
Well, check this out. There were this year 24 homes that sold over $1 million compared to 11 this time last year.
Amazing.
So would you say, is it fair to say that it's because of
Yes, I would say that for sure.
Nice.
I would say for a couple of reasons. One, interest rates have declined.
Yep.
I believe that consumer confidence is high. Inflation is much lower than it was. And I definitely believe that for this, for buyers to get into the market over that $1 million mark, that is, the numbers speak for themselves.
I know.
So it's really exciting,
Yep.
isn't it?
Oh, yeah, I was shocked. Now anything over 2 million, that's still a very soft market.
Yes.
But up to that point, it's still a good market.
It is a good market, and there's a lot of generational wealth being transferred. So we're seeing that also.
Oh, are you really? Okay.
So I think, individuals, parents, aunts, uncles, they're looking at, their overall estate planning now and want to help out their kids today versus down the road when they're not here.
Less tax implications, I found
Definitely less tax implications on your overall estate.
Yeah, no, I went to a seminar with IG, and they were talking about, giving your wealth out now to your kids.
Absolutely.
As opposed to them paying the big tax, 54% tax or whatever it is going to be when.
Yeah. The government's always going to take our taxes, Sandra, whether we're living or we're dead,
Death
right?
and taxes, right?
Yeah.
There's no.
It's the one sure things in life.
So, talk to me about appraisals. Have they changed at all since our market has shifted?
Yes and no. What you'll find is that the appraisals will adjust to the market. So essentially, if a property does require an appraisal, the appraiser will go out to look at various aspects in the neighborhood, demographics, and then they'll look at comparable sales in the last 60, 90 days. And that really will determine the overall value. Having said that, what we're finding in the higher price point areas, we're requiring more and more full appraisals.
Okay,
And
so why is that?
So the difference is that if your mortgage typically is, let's call it 550 and less, and it's insured, meaning somebody's putting less than 20% down. The mortgage insurers, provided that the property, I mean, there's appraisal mechanisms that happen behind the scenes, and so they would have all of the market information, and that's called, you know, either automated valuation or what we call desktop.
Yep.
And so in that price point, typically with all of the information that's gathered, an appraisal is done automatically. It's an automatic valuation. Anything above 500, 550 oftentimes would require an appraisal. And that's because of the higher risk value and the executive style homes, if you will.
Of course, yeah.
And then it depends also on the type of product. So if a client is looking to have a mortgage and a line of credit component to their overall product that suits their current and future needs, then that's when a full appraisal is required also. We're not seeing the market is very strong here. And so we're not overly concerned with homes that are not coming in at purchase price.
Now, are you seeing that at all, though? Like
Not really.
Okay.
Not really. What oftentimes will trigger it is if somebody's purchasing a fixer-upper or a handy person special. You know, if there's something that's within that listing that's going to trigger, you know, the lender to say, look, we need to go do a full appraisal and actually have somebody go into that property to ensure that it is marketable, it is livable.
Okay.
So it really depends on the product, the price point, and the lender.
Okay. So getting back to the first-time home buyer, because they are making up, you know, a huge proportion of our sales here. What options do they have now? Because I still see people like, you know, what's available now for first-time home buyers. What products is out there for
Incentives?
them now? Yeah.
Well, we have obviously the first-time home buying savings account, and that's where individuals can save up to $8,000. That's the maximum per year. They used to be able to carry it forward. Now they're only allowing you to carry forward 1 year, which is interesting. So that was a change. Not heavily advertised either by the government.
But why not though?
I don't know. If I knew what the government was going to do, we wouldn't be sitting here today, right? Having said that, there are lots of ways for first-time homebuyers to get into the market and start saving. So RSPs are another great vehicle.
Yep.
Up to $60,000. They can take up to $60,000 now towards the down payment of a home.
Nice.
Which is great. Now, has to be paid back 1/15, so over 15 years. But going back to the first-time homebuyer savings account, it actually doesn't have to be. You can take it out tax-free, and it doesn't have to be paid back. That's really important. It's very important. And then, you know, in terms of first-time homebuyers, of course, a 30-year amortization. Also, 30-year amortization on an insured mortgage is available for new construction homes.
I know, and I can, if I'm buying my second home that's new construction, I can use that.
You can, yes.
That was a big thing for the government to do that.
And here's hoping, you know, depending on what happens with our current government in Canada, I think that we'll see, obviously, hopefully, even more policy changes that will help first-time homebuyers and every individual who's looking to purchase a home.
If you had to wave a wand, you talked about policy changes, what would you like to see?
Oh my goodness. I would love to see a 30-year M right across the board, amortization for uninsured and insured mortgages, regardless of the type of property. I think that the underlying assets would warrant that amortization. You know, at the end of the day, we own our homes and we own them and live in them for, you know, sometimes generations. So as long as the underlying asset, which is the home, is in good overall condition, then we should be able to amortize that mortgage.
So do you think if that were a blanket, we'd go back to, you know, a lot of competitive offers again?
Perhaps. I mean, again, it really depends on the overall borrower profile. But I think what's important is that we provide options for Canadians who are looking to get into the home buying market or who are currently living in a home and they need to have an extended amortization for cash flow purposes.
If you had to look at your company, Premier, what would be the biggest bulk of your business now? Is it people who are refinancing? Is it, you know, resale? Is it first-time home buyers?
It's a great question. It's a mix of business. I mean, over the next 2 years, a trillion, over a trillion. I don't even have the exact number. Mortgages are coming up for renewal.
Yeah.
And what we're finding is clients today, they need to speak with a mortgage professional who can help them look at their overall financial picture. Some are carrying a lot of debt.
Yeah.
And if you can utilize the equity in your home to pay off some of that debt and create more disposable income, that's a great thing for your family. And it helps create wealth. So perhaps they're looking to purchase a cottage, or maybe it's a rental property. So how do we look at restructuring their overall finances to make that goal and that overall, if you will, dream become a reality? So we're seeing mortgages come up for renewal where clients can move their mortgage from one institution to another without making any changes. And to that end, typically we're looking at a lot of what we call refis or equity takeouts. And it's a pretty good market right now. We're up year over year as a firm, like significantly. And so, our January versus January, we had a great last year. This year, we're ahead of last year. So things are very positive. There's a lot of activity happening. And I think you will agree, as soon as the warmer weather comes a little bit, I think that's going to spur, our spring market.
I don't know. It's pretty good now. I just want to, I told you I was at an event there a couple of weeks ago with IG, and we were talking, it was basically about retirement. And how are you helping seniors at the firm?
That's an interesting question. So,
because you know what? Like, I can now go to Shoppers Drug Mart and get my seniors discount.
Yes, girl, 55.
What's
At 55, 20%. Today's Seniors Day at Shoppers. I wonder if they'll sponsor your podcast.
Oh my God. Like, what? They got to change. It's like 55 plus lifestyle.
I know. It depends. Like, I think the stat is CRA is 60. I used to think it was 55. You're deemed to be a senior or stats camp, but I think it's 60. So
okay.
I'm happy to hear that. But even 60 is very, very young.
I know.
Extremely young when you're facing, it's 5 years away. But there's lots of different programs. And again, what we're finding is a lot of seniors are looking to, who own a home, and I hate to use the word seniors, but let's call them,
older people.
More mature.
Mature. Okay, I like mature people.
Mature consumers are looking at how can they help their kids get into the home buying market? What can they do to help them? And so if they have significant equity in their home, they're taking that equity out. And as we said earlier, they're gifting it to their children today to help them. So yes, there's things that we're looking at and talking with the family as a whole. And then of course, if it's somebody that's in their home and let's say they're 65, 70, 75, 80, I mean that we're living longer.
Yeah.
And so in Halifax or Nova Scotia, we have the highest aging population in the country in Nova Scotia. And so we have a lot of, I'm going to say senior citizens in this case, that are living in homes that don't have a lot of disposable income coming in, and they're living on CPP, OAS. Their homes need to be, updated, retrofitted for whatever their particular needs are. Perhaps they need home care, and they're in a position where they're asset rich and cash poor. And so there are mortgage vehicles to help, and that's the CHIP mortgage, the Canadian Home Income Plan Fund.
So can we talk about that for a second? So let's say, the house is worth $300,000, right? I know a low number. And how much could I take out let's do 500 because that's a good number. If I own my house, it's worth $500,000, I'm a senior, how much money can I get out of my house?
The older you are, the more you can get. So it's up to 55% or up to 50%. It's almost like an actuary, if you will. And but having said that, that product has been modernized, if you will. So there are opportunities to take even more equity out if you want to pay it back on a monthly basis, a principal and interest portion.
But do you have to pay it back?
You don't. So there's a reverse mortgage. That's right. And so reverse mortgage is you take the mortgage out, and when you go to sell the home, it's paid off. Or if something happens, your estate can pay off the mortgage for you. So there's no payments. There's options depending on the overall need of the borrower. It's becoming more and more popular. And again, some of the homes, the let's call it the older stock, resale stock in Halifax. Some of these homes haven't been updated in many years.
Yep.
And they need wheelchair accessibility, or they may need, their bathrooms to be retrofitted or counters lowered. And so again, they don't have the cash to do that, but they can take the equity out and they can retrofit their home to suit their needs, and or they can take monthly income. Instead of taking a big lump sum, they could actually take a monthly income to help them stay in the home and pay caregivers.
So if they took out $100,000, the house
Yes.
is worth $500.
Yes.
And as long as that $100,000 is it $100,000 plus interest?
Yes. So it's not free. There is
No.
interest.
How much is how?
It depends on the term. Again, I can't give you definitive numbers
No.
because it depends. It's a higher interest rate because the
course.
risk is higher.
20%?
But no, God, no.
Well, that's cheaper than a credit card.
Let's call it 7. Let's call it 7.5, maybe 8. Again, depending on the term. But it is a really great solution to help people to stay in their homes today.
Are many people, mature consumer, are they looking at that?
Some are. I think some are concerned about it because this particular product used to have a really negative
I remember
connotation.
that probably about 10 years ago.
Yes, it was. Everyone believed, well, and it's a bank. Home Equity Bank is a Canadian chartered financial institution. It's a bank, and they're under the purview of OSFI, so they're regulated. Many years ago, this product, again, perhaps the lending institution at the time would take ownership, if you will. That doesn't happen. It stays in the borrower's name. And there's just a lot of misinformation around the product. But it's very powerful. It's a needed solution for many people.
So to confirm, the house is in the mature, let's say mom and dad.
Yes.
Mom and dad, they take $100,000. The house is now willed to me. So yeah, I guess the estate just pays for it.
The estate pays it back.
Like the $100,000 plus whatever interest.
Yes. And if you have the cash yourself and you want to pay that mortgage off, you can pay it off. If you were inheriting.
Okay, and no penalty.
And there are penalties, but it depends on where you are in the term. There's always going to be some sort of penalty because it's investor based. But it just depends on the term, the initial term that the client has taken, and or it could be in an open, but you're going to always pay a much higher interest rate when anything is open from a mortgage or line of credit perspective.
What a great product.
It's a great product. It's a needed product. It fits a need, and it's a feel-good product.
How could it not be?
Right, because you're helping people. I mean, how many people do we see out there that are really struggling and they're seniors?
I know.
I don't want to get political here, but our healthcare system is broken, shattered.
But that's not everywhere.
That's everywhere. It's everywhere.
Right? So you just can't label us, but...
No, that's right. But you can stay at home, and maybe you need to hire personal care workers, and you've got the equity in your home. You can take it so that you can help to afford that care.
Can a mortgage broker anywhere in Canada help someone in a different province, or you just got to go with your own?
It depends if they're licensed. Okay. So to be a mortgage broker, you are licensed by your provincial regulatory board or environment. And, I love your question. I think it's very critical that you ask that. If a client is living in Nova Scotia and they're working with a mortgage broker who lives in Ontario, and they are not licensed here in Nova Scotia, they shouldn't be working with that individual at all. But many mortgage brokers hold multiple licenses. So you can be licensed in every province in the country. But it's important for consumers to work with a licensed mortgage broker associate.
So that's a whole different ball game now that I want to ask. Because I'll get clients coming in and, oh no, my broker's in Ontario. And for me, I'd rather work with someone local because they know our contracts. And because most of Ontario people, they wouldn't know how our contracts work, what our forms are. But I never thought can you ask your mortgage broker if they're licensed in Nova Scotia?
Absolutely.
So if they're not licensed in Nova Scotia,
I would say to them, if you're not licensed as a mortgage broker in Nova Scotia, unfortunately, I'm not prepared for you to work with my client. Do you?
But they do though. They do it all the time.
Well, some are licensed though here, so they've taken the time and they're paying and they're getting the education.
Okay.
It just depends. It just depends who this mortgage broker is.
Okay.
Does that make sense? And there are lists, like you can go on the regulatory website.
I didn't know that.
Yes. It's just important to work with, just like you. You know, we want our clients to be looked after. We are all about consumer advocacy.
Yeah.
And it's important to understand the regulations here in this province, and it's important for somebody to work with a licensed mortgage broker or associate who understands our region too.
Oh yeah.
Right?
Yeah. Has there any, have you ever come across any examples where it was a bad scenario?
I would say yes, and a lot of those examples were happening during COVID.
Oh yes.
And I hate to go back there. Because we're so much past it, but yes, because people were moving and selling their homes and just arbitrarily moving to the East Coast and trying to buy a house without getting financing in place because their broker in Ontario told them it was okay. But it does happen. It's going to happen in any profession.
Yeah, no, I agree. Well, Michelle, thank you for coming out, and we'll do it again next month for sure.
I would love to, and I love chatting with you, Sandra. Thank you so much.
Well, thank you.
You're welcome.